Huh. Why is this? All right, doesn't matter. We'll go to full screen. Sorry. Okay. All right, we're ready to start. Go ahead.
Yep, it's recording.
Oh, okay. Sorry. Hi, guys. Boris Schlossberg, BK Forex with Pepperstone. Welcome to our monthly webinars with Pepperstone. I'm very, very excited for this one because it is awesome. I actually turned myself into a guinea pig for you guys for this webinar to test out all of these ideas myself on my own accounts. I'll show you all of them, and I'll also show you which one I am personally like very much as a trading strategy. Feel free to discuss all of this as the webinar goes by. I actually can see all of your questions, so feel free to post anything that comes to your mind as I'm talking. I'm happy to answer them. I'll repeat the question to the whole group, and then I'll answer it as we go along. So without much ado, welcome to the 3 easy ways to day trade trend. As always, trading foreign exchange or margin carries a high level of risk, may not be suitable for all investors. I ask you to read the disclaimer very carefully to understand all that are associated with trading the margin, and to seek advice from an independent financial advisor if you have any doubts. Please read this disclaimer very carefully to understand that the information contained here should not be relied upon as a substitute for independent, extensive research, which should be performed before making your investment decisions. So, without much ado, let's focus on what I think is the single biggest mistake that trend makers make, or trend traders make, which is, I wonder if anybody knows what this word means. Do you know what FOMO means? Let's see if anybody can type that out for me. I'm just curious if anybody has heard of it. Fear of missing out. Yes, everybody knows this word. I don't think there is a greater, what's the word I'm looking for? The greater sin, a greater ruiner of good trend trading strategies than the fear of missing out. The essence of bad trend trading is chasing price, right? And if there's nothing else that I can show you today, it's hopefully the idea that you can trade trend without chasing price, and that just one single behavior should radically help you improve your results. So FOMO is just an incredibly dangerous and very, very seductive thing that we all do, right? I don't think there's anyone in this room right now that has not chased price, including yours truly, at least once a week. And what I mean by chasing price, of course, is especially on a day trading basis, when we have a melt up or meltdown of price action, right? You have this huge move. The temptation is to always join in just as the peak of the move is happening, or just as the nadir of the move is happening. And I think that because what's happening is that prices are moving very, very quickly. They're moving in a direction, and you're like certain that if they're moving this quickly and they're moving in that direction, they're going to continue moving in that direction in perpetuity, right? This is always our human frailty, is to always extend the present into the future. And that's always a very dangerous thing. So never chasing price is just simply the most important thing. If nothing else, is I leave you with the idea of don't chase price when you trade trend. The key is to buy weakness or to sell into strength, depending on what you're doing. Obviously, we're going to establish the idea of what is trend, but regardless of how we establish the meaning of trend, we're always going to try to buy into weakness or sell into strength, with one tiny little exception, which I will show you. Now, why is this so important? The reason why it's so important is because it's extraordinarily important to play the probabilities. One of the more interesting things that I think you guys will find, those of you who've been with me in the webinars before, and those of you who have sort of hung out with me in the BK chat room, I have gone through, I think, a pretty tremendous transformation in trading 2018 versus trading 2016, 2017, in a sense that I have actually decided to go for much worse probabilities, to trade at worse odds but with much better risk-reward ratios. And I'm going to show you, the strategies I'm going to show you are going to reflect that. And it's not the situation, it's not a matter of whether what I was doing before was wrong. It's just that I think doing it this way is better. So because you need to play probabilities, the question isn't, you know, do you want to be right all the time? The question is, you just need to be right a little bit of the time. My most critical change this year, and one that I'm going to show you in the strategies that I'm going to propose, is that I don't need to win all the time to win. This is Puggy Pearson, who is a legend in the world of poker. As you can see, he's hardly the face of someone who graduated as an MIT applied physicist. He's a street fighter who has been extraordinarily successful at trading poker because he basically has these three following rules, all of which, in my opinion, are incredibly relevant and highly, highly applicable to all of us, which is that he said there's only three things to gambling: knowing the 60-40 end of the proposition, money management, and knowing yourself, right? So part of, like, let's sort of reverse this statement, because there's so much here to unpack it. I really want to discuss it for just a minute here. Knowing yourself is basically knowing that we're going to chase price, right? It's not a question of whether, if we're going to chase price. It's just a question of when. None of us is disciplined enough not to chase price, right? So if we already know that that's going to be our primary psychological weakness, we have to try and create strategies that avoid that at any cost, right? That don't entice us into doing that as we go forward. Money management is simply the idea of trading proper size. Now, I've talked about trading proper size a whole bunch of times before. I mean, I'm happy to discuss it a little bit here, but my primary point about trading proper size is that I generally think the rule of thumb that I like to use is if you have $10,000, be they Australian or US, in your account, and you're day trading, and you're going to essentially, your average amount of trades is going to be about 10 per day, which I think describes almost everybody in this room, right? We all pretty, this is sort of like, I would say this is the prototypical FX retail trader. 10,000 in the account, about 10 day trades a day. The problem is that the prototypical retail trader is going to try to trade that, each single trade, at maybe 100,000 units, or maybe even 200,000 units, which is ridiculously too much. Because what you should be doing, even though it seems like it's a very small amount and it's really not exciting, is trading $10,000 at 10,000 units, 1-to-1 ratio. And the reason why you do that is because if you think about this, if you do 10 trades a day, that is equivalent of trading 100,000, right? 10 times 10, you're already trading 100,000. You're already leveraging yourself up. You're just not leveraging yourself up through leverage. You're leveraging yourself up through turnover. By flipping over 10 times your whole portfolio, you've actually levered up your capital to 10 times the size. And frankly, that's the most you can do without blowing out. Now, you can scoff at me. You can say, it's nonsense, Boris. I'll put in $500,000 position in a $10,000 trade, and I've made tons of money, and I've doubled my accounts. And I'm sure you have. But it's not the money that you made. It's the money that you keep that matters. And I can be certain with 99.9% certainty that if you're trading it at 10 times size and you're doing 10 trades a day, within 6 months, whatever money you made, you will lose, and you will lose your whole account, because it's just simply the mathematics of the game, okay? You cannot drive, unless you're German, you cannot drive on the highway at 150 miles an hour for 365 days straight and not blow up and kill yourself, okay? It's just mathematically impossible. You will hit a small pebble and it will drive you off the road. So money management is the second component that I think we should all very much take take care of. And it's easy because, so sort of these two components are very easy to construct because we can construct them ahead of the trade, right? We create a strategy that doesn't chase price, and we basically, whether we're using MT4EA or using our own manual trading, just simply set our average trade size, our starting trade size at 1 times whatever is our account, so that we don't over leverage ourselves. So is that pretty clear to anybody? Does anybody have any questions on those two components? Because those are effectively can be set up ahead of time, and we can control that with 100-degree or 100% degree of certainty. Is that clear to everybody? Okay. Or if it's not, feel free to to post. Now, the third component of Puggy's formula is the one that's most interesting, because Teshin is asking you 1% of 10,000 account. So I don't want to get confusing, because 1% of 10,000 account is $100. No, that's it's maybe 1% of margin. Yes, to make it very, very simple, if you have 10,000 in your account, your opening trade size, the size of your trade, should be 10,000 units. If you have $1,000 in your account, your opening trade size, the size of your trade, should be 1,000 units. Okay, that's what I'm saying. That's the key thing. It's the size of your trade, not the amount of margin you have. You have infinitesimal margin, and Pepperstone will give you, I think, 400 to 1 margin, maybe 200 to 1 margin, depending on jurisdiction. So, in other words, you can trade up to 2 million on that 10,000. Just because you can does not mean you should. That's what I'm saying. You should be trading controlled small size. And I'm giving you perhaps the single most conservative way of doing it, but better be safe than sorry. Take my advice for what it's worth. Now, the third component of all of this, knowing the 60-40 end of the proposition, that's the most interesting part, because that part is actually impossible to gauge, right? We cannot know ahead of time what the odds are. All we can know is, generally, given the past, it's possible to make a relatively confident assumption that the future will be like that, right? The other day I posted on Twitter, I thought it was kind of pretty clever of me. I said, trying to make money in the future by trading the past is a hard way of doing business, which is essentially what all of us do, right? If you think about this, what do all of us do? We create strategies that work in the past and assume that they will work in the future. That's a hard thing to do. But what Puggy says here, and I think is kind of interesting, is that you don't have to be correct a lot to have a positive edge, right? As long as you're 60-40, my friend, and this is where I'm going to talk to you about risk-reward ratios, you can come out ahead with a relatively high degree of confidence. As a matter of fact, as long as you're 60-40, you actually have 10 percentage points of leeway before you begin to lose money, right? Now, there's no guarantee that you're going to be 60-40. But if you're sort of trading a setup that looks like it's 60-40, and if at the end of the year it's 57-43, you're still doing okay. That's my key point. So I thought that was kind of interesting and really, really important for us to understand before we even begin to understand the trend trading issues and all of the issues that surround it. But trend trading, above all, is really all about controlling risk, as I explained to you. The ideas of controlling size, right? Controlling entry, and then hopefully controlling our odds as much as possible. So a couple of things that we need to control before we even begin to trade, right? This is another thing that I think a lot of people completely misunderstand when they begin to day trade on a trading basis. Most of us just assume, hey, I'm going to come into the market whenever I wake up, whenever I look at it, whenever I feel like it, and I'm just going to find a trend and I'm going to trade it, right? If you come with that attitude, you're already at a huge disadvantage, because the FX market has very specific times when trend trading is really highly probable, and very specific times when trading is highly improbable. Now, does that mean that in all those times it's always going to be trend, and all the other times it's always going to be not? Of course not. Just probabilities. It just means that there's a much higher chance that during certain times of the day you will have trend movements, and other times of the day you will not. To put it in simple terms, certain times of the day breakouts will work, and certain times of the day they're almost guaranteed to be fake outs, right? And the time of day is just in fact, I would say more important. In fact, that's why I put it up here. More important than whatever setup you're doing. I can take the worst of your trend setups and put it on the right time of day and pretty much give myself a positive edge. And I can take the best of your trend setups and put it on the wrong time of day, and it'd be lucky if I break even. So time of day is incredibly important. So this is GMT time, right? To kind of normalize it for everybody. And this is sort of the the FX day. Sydney, then Tokyo coming into GMT time. I think this is summer hours. This is summer hours, right? So 2100 is the close of New York, the open of Sydney. So that's right now we're basically at 2200 hour GMT time, but it doesn't matter. We're moving 1 hour, the other hour, one way or the other. We are now. What time is it? GMT. What is it? It's 5. So we're like right here. This is 9 o'clock, right? We're London, right? We're London over here. So this is the whole day. You see the intersection of Sydney, Tokyo, London, New York. I'm happy, if you guys, I'm happy to share this slide with you if you guys want. I'm sure if I give you the PDF to this presentation, I'm sure Pepperstone will give it to you guys as well. You can see this. Now here's where it gets interesting. I think, by the way, is this correct? Is it Australian Eastern? Is it AET or AEST? I wasn't sure what the terminology was, but what I did was I basically blocked out what I consider to be the highest probability trend times, the highest probabilities when trend really happens. And it's essentially, when you look at it, it's basically the open of Asia, the open of Europe, the open of North America. This is when most of the flow gets done. So that's right, Australian Eastern Standard Time, right? There we go. See, I'm right, Gary. But hopefully this is kind of clear to you guys. We're essentially now in the Australian mid-evening. It's evening for you guys, actually. It's 8:30, 9 o'clock, right? Great time for you guys to trade. You come back from home. This is an excellent time to trade, right? And if you're in Oz, you have two opportunities. You can do the morning trade, or sort of for you guys, it's really kind of like an early afternoon trade. 11 to 13 is a very, very decent time to trade in Australia. And this is a very, very, the best time to trade is evening time in Australia, because you have all of this intensity of the European Open, right? And then if you're really crazy, like some of the people in my room who are Aussies who are nocturnal by nature, you can then trade the whole midnight session. But the good thing is, by 2 o'clock in the morning, Australia, you're pretty much done. There's nothing really going on over there. This is daylight savings time and Australia savings time. Okay, whatever. So adjust for 1 hour. But I think you guys get the gist of what I'm talking about. There are certain chunks of the day when you really want to apply these setups that I want to show you, and there are other chunks of the day where you kind of just want to avoid the trading. So the other thing that you want to avoid, so one, you want to choose the right time. Two, the other very, very important thing is you never want to trade trend on a day trading basis. This is a critical thing, on a day trading basis in front of news. I think this is pretty self-explanatory, but a lot of people still forget that. A lot of people still forget that. They're going to be, let's say they're holding a trade based upon some indicator action right in front of a major calendar release, which is just suicidal, right? I mean, it doesn't matter what the indicator said 5 minutes ago. the reality of price is going to be set by 5 minutes forward. This is sort of, I think, the ultimate flaw of trading the past, of trading the future by looking at the past, right? Nothing changes the future more than news. So you certainly don't want to be in front of news, right? So Forrest is asking, how do we know all the major news coming up? There are literally 1,000 calendars. A very, let me just sort of show you, a very easy way of looking at stuff is Forex Live. My friends at Forex Live, you can simply go to their economic calendar. They've actually, just today, they changed the calendar to like a kind of a nice looking calendar, and you can see every single event, right? This is done in GMT time, and it's telling you, for example, 9 minutes to the European Consumer Price Index, right? Today, the big event, anything that's red is a big event. So today, if you're going to trade Canada in the late Asia session or in the overnight Asia session, obviously the Bank of Canada rate decision is going to be massively market moving, right? So there's a lot of different resources. This is as good a resource as any. I use it all the time. It's super easy to get a hold of that, right? Okay. Now, the third preparatory aspect of how to trade trend, which I think some of you guys will really find very interesting, trade management, right? So we talked about several things beforehand. We talked about the idea of trading size. We talked about the idea of creating structures that sort of control our worst impulses, right? We talked about trading time, which is a key filter. Talked about trading away from news, another key filter. And the last component that I want to talk to you about is the idea of trade management. And there are really sort of 3 different type of trade management strategies. Single entry, single exit. Scale out. Scale out is where you do a single entry and multiple exits. So you do one entry and you do multiple exits, right? And the last one is average in, where you do multiple entries and either one exit on the whole position or multiple entries, multiple exits. Either way, you can do this, right? Now, I'm going to sort of propose to you that when you trade trend, the best strategy, or the ones that I'm going to show you today, are going to be single entry, single exit. But there's reasons why I think only these 2 are really valuable and valid strategies for trading trend. So this is single entry, short, the big down move, consolidation. You short the consolidation, and you see, boom, boom. You got a downward move. Trend effectively is a momentum phenomenon, and what that means is that it's either yes or no, right? It's either going to move or not move. There's no there is no 2 ways about it. Trend, because it's a momentum phenomenon, is sort of a binary analysis device. It's either going to go or not. So you can do a single entry, into a target. You can do a single entry and multiple exit targets. So let's say I short this, exit 1 at +5, exit 2 at +10, exit 3 at +15. And what this does is it allows you to take some position off very quickly, take some position off on an intermediate move, and if you get very lucky, the long-term move, the big move, you get some of the position off, right? This way, you have a probabilistic blended return that's quite good, right? But what you definitely don't want to do is this thing, which is averaging into a position, right? Let's say you sell trend over here at the bottom. Just bear with me. And instead of recognizing the fact that you were just wrong, you sold the bottom, right? You sell more here, sell more here, sell more here, right? And what happens is you're basically averaging in against another trend. You're trading. The trend has changed, but you haven't. and you're adding to your woes by essentially going the other way. The key thing about trends, the most dangerous thing about trends, is a V-shape, what we call a V-shaped bounce, where it comes down this way and then completely reverses, goes the other way. A very, very good example, right? A great example today was buying euro dollar, right? If you bought euro dollar today at 123, we were actually very fortunate. I sold the euro dollar into the highs, into the 23s, or selling dollar yen today at 110.30. Either way, if you continue to fight this move and you kept buying your dollar at 22.70, 22.60, 22.50, all you have done now is accumulated mass amount of losses. Same thing with dollar yen, right? Trend is a yes/no proposition. So Forrest is asking me, do you trail or stop to protect profit when it's working? I do. That's a third strategy, but it's a little more complicated, so I didn't want to bother with it. And it's extremely hard to create definitive odds, right? I know what my odds are on a trail basis, but for simplicity's sake today, I just wanted to show you single entry, single exit strategies. Ari is asking me, does averaging in includes by adding profit positions, or is it just averaging down only? Both strategies, in my opinion, are dangerous. Both of them are dangerous. I don't want to get off topic and talk about averaging into profit, but I will just simply say that if you're correct and you add more to the position as you're correct, you stand the chance of losing the only time that's going to work, and it's going to work big, it's called pyramiding, right? Let's just assume the following. You sell here. Let's just go the other way. Let's just let me go. Hang on a second. I'll show you why pyramiding can be so dangerous, right? Because it only works under one condition. Oops, sorry, come back. So I sell here, then I sell more here, then I sell more here, right? Let's just take your example here. All right, I sell here, I'm looking good, right? I'm making money. I sell more here, I'm still looking good. I'm making money. Now I have twice as much position, but it's going my way, right? Then I get super greedy and I say it's going to go more, and I sell more over here. And literally, the mathematics of your strategy, if you just go up over here, you've lost all the money you've ever made. All this money in your pyramid comes crumbling down, and you've lost all your money because you're long here, you're short here, you're short here, you're short here, you're short at the bottom, and this particular thing becomes massively losing right away. This becomes losing very quickly, and this completely evaporates all your losses. So there's a huge downside to averaging into profit. And of course, there's a downside to averaging down into the gains on a profit basis, right? Okay, got it. Okay, super. So that's the key thing that I wanted to just sort of show you, that to me, trend is a single exit or scale out per position, because it's basically how the whole structure of trend works best. Okay, there seems to be one person who either doesn't agree with me or seems to be confused as to understanding what I'm trying to say. But I hope everybody else is super clear. I'm going to review again all the points for everybody else in this room. Number one, we want to trade control size. Number two, want to control structure. Number three, want to control time. And then finally, we want to control our exit structure, our strategy structure, which in this case is a single exit, single entry, single exit structure. Is that clear to everybody? So before we've even looked at strategies, we have all these rules that we're doing on a day trading basis. Okay, super. Everybody gets it. A couple more questions. Let me just get to the questions before I get to the strategies. We're doing pretty well on times here. So, and if you don't mind, I tend to always go a little bit over time. So I hope you guys will hang out with me, because I have 3 really good strategies that I'm going to share with you So we'll deconstruct them very, very carefully. So Craig is saying, what if you do multiple trades at once with different TPs, you reduce trade size? Is that by Craig? By that you mean single entry, multiple exits? I'm talking about right now. We're just for argument's sake and for model's sake, we're only looking at one currency pair, one trade. We're not talking about portfolio trades. We're just talking about how do you want to approach a single trend day trade structure, right? You can then, of course, layer on more complexity, but for our purposes, we're just looking at one currency pair, one trade. Somebody says, why scale out if you could just move stop loss to a new level? Neil, great question. So let me just sort of reply to that, because I think that's it's an excellent question, right? So because I do this myself, and I'll explain to you the benefits and the flaws of each one of the structures. So if you do what's called a scale out structure, right? Let's say I'm in a trade, right? In a third of my trade, I guaranteed I've locked in 5 points, right? Then another third of my trade, I guaranteed I've locked in 10 points, right? In a third of my trade, I now guaranteed locked in 15 points, right? So 10, 15, 10, 15, 5, I've locked in 30 points. You with me on this, Neil? That's, I guarantee, because I've exited out of those positions. That's the value of scale out. Now if I'm trailing my stop, I have to give myself room to trail, right? There's obviously room to trail, because if I don't give myself room, I'm just going to get stopped out right away. So let's just, for argument's sake, I give myself a 10 pip room, right? 10 pip trail behind this, right? If I'm doing this, and let's say I get greedy and I'm going to go for 20 pips on my target, I don't quite get back up to 20 pips. It never hits my target, right? So now the price starts to retrace, and now my whole position gets taken out of +10, at +10. So when I'm trailing, by very definition of the strategy of trail, I am going to almost always exit at smaller profit than if I have hard targets on the position, right? Unless I'm in a very, very favorable move where it just simply skyrockets through the move. So depending on neither strategy is bad. Both strategies are very good, but depending on your personal style, your mental frame of mind, the kind of strategy you're doing, you should experiment with one or the other and see which one works best. I happen to like both strategies. For right now, I'm simply trading single exits, scale out, but I actually trail out my strategies on some of the other stuff. But in these particular strategies I'm going to show you, I'm just going to do simple exit, simple entry strategies. Okay, but neither one of those money management techniques are bad. You just have to understand the nuances of what each one will do, both psychologically and financially to your position. All right, super. Let's start talking about strategies, because I want to show you three strategies that I think are very interesting for day trading on a trend basis. The first one I call the RSI deep retrace strategy, and this is essentially using the RSI to define trend. The first and foremost thing we need to do when we're trading trend is to actually quantitatively, not like fuzzy wuzzy, oh, I think it looks like it's going up, but quantitatively define trend within this particular structure. So how do we define trend? In this particular structure, and this is actually because I think some of you guys will find it surprising, I consider trend to be up if RSI reading is equal to or greater to 70 on a 1 minute chart. We're going to trade this on a 1 minute chart. Or I consider trend to be down if RSI is less than or equal to 30. Now, most of you are used to using RSI as a fading mechanism. Basically, 70 is overbought and 30 is oversold. To me, no. To me, especially on a 1 minute chart, that's just actually when things are getting started. If the market is going 70 RSI, that means something is happening in the marketplace to convince it that the trend is up. If the market is going 30 RSI, that means something is happening in the marketplace to convince it that the market is going down. Those are great trend signals, not the opposite. So the way we trade the deep retrace on the long side is we simply looking for a couple of things. we're looking for the 1 minute chart to go up to 70, right? And here's where it gets very counterintuitive. So just bear with me for a second. Then we're looking for the RSI to fall all the way down to 32. Massive, massive, massive collapse of the RSI values. Momentum really comes all the way down, right? Where you think, wow, it looks like they're selling it, not buying it, right? Then step 3, we're looking for RSI to come back up above 32 and close on a one. This is all closing basis on 1 minute chart. If we get that kind of a structure, then we're happy to buy at market on that particular structure, to enter at market with a stop of -10, target +10. 1-to-1 risk-reward ratio, right? All we're looking for is, we're basically saying that if conditions occur in this particular structure, we have a lot of confidence that we're going to be accurate 60% of the time. Maybe even if we're lucky, 65% of the time on a 1-to-1 risk-reward ratio, right? And the last thing that we sort of put into the structure is, what happened here? We started at 70, it drops to 32, and it doesn't even come back. It just keeps dropping and dropping and dropping. Well, if it drops down to 10, then obviously the uptrend is completely negated, and we abandon the trade. There are a couple of interesting logical formulations in this particular structure that I want you to understand and notice. First, we have a quantitative way to determining trend or uptrend. Secondly, we're basically buying the retrace. But here's the interesting point. We're not just guessing that it's a retrace. And we're not just simply saying, hey, if RSI falls to 32, step in and buy. Assume that that's the bottom of the retrace. No, we're going to let the market prove to us that this indeed is the bottom by having the RSI come back from 32, back up, down, up, down. That whole up-down structure is critical for us because it confirms to us that indeed the market has bottomed at this particular value, and we have a reasonable chance that it's going to work as an up trade, right? On the short side, it's all the reverse. First, we start with 30, and then we're looking for a rise all the way up to 68. Then we're looking for the price to fall back, to reestablish the short bias. This is really, all we're trying to do basically is we have a short bias, then we have a long retrace, and then we're looking for a reestablishment of a short bias. Same thing. Sell at market, 10-10, stop target, and if RSI continues to a long bias towards 90, then obviously we cancel the trade. So that's literally it in terms of this is the mathematical composition of the psychological structure, which is we have a short bias, we have a long bias, we have a retrace the other way, and then we have some signal of a pause and a move back to the original bias. And if we have that, then we're going to take that trade and go with it. So here's dollar Swiss RSI deep retrace on a long side, right? And as you can see right over here, this is a 1 minute chart. These are all New York times. This is all New York time, so 1 o'clock in the morning New York time, which is, if you go back to that chart that I showed you, the right time. This is Asia afternoon. It's a very good liquidity time. There's a lot of, we usually between like 1 and 3 in the morning New York time, you get a lot of movement in Asia. It's a decent time to trade trend, right? So here we have obviously an upward bias, right, as defined by the RSI. And then we have a big retrace here, and it comes down to 32, and then it comes back up. That little candle, like right over here, comes back up. We get long. As you can see from this chart, literally no pain on our, we pretty much bought the bottom. Now, does that always work that way? Of course not. But buying the bottom in this particular case is exactly what we're looking for. Up, retrace, boom, right? And the RSI helps us to time this in a quantitative measure, quantitative way. So you could then simply trade it in a quantitative way. Here's another good long retrace. This is dollar CAD, the dollar CAD over the Asia afternoon into the London Open. And here, it establishes an up move, then it does basically a 40-minute retrace all the way down to the bottom. Again, we buy the bottom. We buy the bottom because we get a signal here. If you notice, there's a green candle over here. That's the one that changes, that gives us a signal that 32 then goes up to 36 or whatever the RSI value is at that point. We get long, 10-10. Now, by the way, all of these examples, I sort of skipped over this part. I recommend, it's up to you, obviously, But all of these examples that I'm showing you are with spread, baked in. I'm trading this on spread-based accounts. In other words, Pepperstone obviously is very, very good because it gives you the flexibility to trade on spread or to trade commission-based. But if you're trading commission-based on a day trading basis, then you really want to give yourself one extra point of profit so that you can pay for the commission. So if you're trading commission-based accounts, I would make the target 11, not 10. But these are all spread-based examples that I'm giving you. Yes, sorry. Somebody has asked me a very obvious question. Chen is asking me. He says he sees RSI 14. Assume everything I give you is standard settings. It's so obvious to me that I sometimes forget to say that. RSI's standard default setting is 14. We're using standard default setting. That is what we're using here. So absolutely, yes, you're absolutely right. This is based on a 1 minute chart. And the trend, Gary, is established by the RSI value. It's not based up, I'm not looking at the price values, okay? The price obviously is showing me a nice little uptrend, right? But I'm not looking at that. I'm actually looking at the RSI to establish an uptrend. In this particular case, you can see the RSI started an uptrend quite, for a couple of times, and it never came. Here's the other point that I want to explain to you. You need to be patient, right? This is the whole idea of fear of missing out. The RSI never quite comes down to these oversold levels until over here, right? It made one uptrend, second uptrend, right? And only after the second uptrend do we have a little bit of a profit release valve, and only then do we get a chance to really buy it at good prices. So very important to give yourself the patience to let it come into you. Do not try to buy it over here because you didn't buy it over here, right? The typical retail trader is gonna see, oh, it's going up, I'm gonna buy it over here, right? Now he buys it over here. The first thing that happens to him is he starts losing money. As he starts losing money, he gets shaken out. This is 25.80, right? 25.80, he's like, oh, I only won 10 points, and now he sees that it's now 25.60. Boom. He's like, I'm going to stop myself out. I can't take the pain anymore. Now he's lost 20 points, utterly unnecessary. Was he wrong on the uptrend? No. Was he wrong on the price? Absolutely. The whole point of the deep retrace is that it helps to get you to be right on the price, right? I didn't come in chasing my move. I came in right here, and therefore my price was good. It's not good enough just to ascertain a trend. To trade trend well, you need to come in at the right price. That's really the key to the setup. I generally use this primarily on the majors. Forrest is asking me what pairs is this good for. I use it mainly on euro, yen, pound, Aussie, and CAD. Those are all good pairs to trade this on. Here's a short example, and you can see there, most of my pairs are all majors. So here's euro dollar. Euro dollar. Now, this is the interesting thing. Euro dollar is in a negative trend over here. This is 6 o'clock in the morning, New York. So clearly, European, London morning, afternoon, morning. New York starting to wake up. Very, very good time for trend-based trades because you get this London-New York interchange, which is when a lot of the movement happens. Euros is clearly on a down leg in this particular market is selling euros all morning long, right? You see it establish a negative negative trend move here with negative bias, and then it takes a really long time, like an hour, for the trade to get back up. By the way, if you're wondering why this wasn't a trade, because even though this looks like it is 68 on the charts, it actually wasn't. I think it was like 65. It just missed. I just missed the entry, right? Just missed the entry. So here we actually get into 70, and then we break down to below 70 to around 68, and we take the trade over here, and boom, very nice and easy, smooth trade. You make 10 points again with very, very little retrace. And there's actually more continuation in the trade if you wanted to. The point being is, you're never going to time it perfectly. You just want to time it the best you can in any of these structures. Here's a downward move, downward trend in Swissy, right? And then Swissy rallies up really, really strongly. And this is where you got to really trust the setup. You got to really trust the setup. So then you have a big flush. Swissy kind of drops like 20 points in this particular candle. Clearly, RSI goes from like 70 to like to 30 or 20 in one candle, and you say to yourself, well, it kind of seems to blow through through all of my values. Do I really want to come in? The answer is generally yes. If you had a negative bias, right, it kind of came back up, retraced, and then the negative bias got confirmed very, very strongly with a very strong move, it's worth it to take the trade, right? Worth it to take the trade. So in this case, we still stayed within our structure. It still followed our result, even though this wasn't a mild turn, it was a sudden, sharp turn to the downside, reestablishing the bias. And of course, we get we get false moves. I want to show you some false moves because you need to understand this is only a 60-40 setup in the best of conditions. You're not going to win all the time. If you win 6 out of 10 times, I will have done my job. So here is New York time, good time. This is New York time. The only thing I will say, and this is a key point, is look at the time New York. This is 10 o'clock in the morning New York. This is pretty much when London is kind of winding down. New York is pretty much done with the morning stock market equity session. And this is where a lot of the momentum starts to seep out of the market. A lot of liquidity starts to seep out of the market. So the timing becomes a lot more problematic here, right? But here we had an upward bias, right? Upward bias in the in dollar yen, right? We have a big retrace. We have a small pause here. I get into the trade because it looks like it's going to turn back up, and it doesn't. It just flushes right back down, which is very normal and totally totally understandable for this setup. Here's British pound, another notoriously tough pair to trade, the handicap. It's in a downtrend, early morning New York. It starts to come back up into an uptrend, right? It pauses, and you think, oh, it's going to come back and reestablish a downtrend back down to 34.50s, and instead it simply blows up and moves towards the 3500s. Again, completely natural and totally normal. The thing about the setup is not that it's perfect. It's just that it's better than even money. That's all that you want it to be, right? So that's the RSI deep retrace, both on the long side and on the short side. So I'm aiming for 10 pips using this strategy. That's correct, Henry. I leave the targets up to you. I like to trade. I generally find that if I'm day trading, my perfect target is around 10 pips of target, right? Albert is asking me a question, which I need to just. It's going all the way. Let me just read this question. Hi, Boris. On the first example of RSI deep retrace short, you took profit at the 10 points. Would you have held the position as went down a few to follow your rules and get out at my plus? No, it doesn't matter where the trade does afterwards. In this particular thing, it's a single entry. Here's how my mentality goes for all of these setups. I don't care if it's 1,000-point move to the downside, right? Yes, you may get some days where you're going to get, you've actually hit the huge trend. It's not what this is about. We are day trading. By definition, day trading means we have limited profit, limited risk, limited on both sides. If you want unlimited profit, then you can't have unlimited risk, right? We're taking morsels out of the market. And the way we make our money is not by saying, oh, there's this one huge trade out of 100 that I hit, right? I hit one great trade and I made all my money in that one great trade. That's generally how, most lucky traders make their money. But the most professional traders make their money by putting together 10 trades, of which 4 are going to be losers, 6 are going to be winners, and at the end of the day, you're up 20. And if you think 20 is a small amount of pips, then let me explain to you that if you have 250 days at 20 pips, you have 50% on your money without any leverage, if you can do that. That's how professional traders trade. So my mentality is completely different from the kind of, oh, let me just find that one single trade that's going to make my account into a millionaire. I am doing it slowly and one trade at a time, irrespective of whatever is the move in the market, right? It's all about controlled risk, controlled entry. So here's strategy number 2, the Bollinger Band Fade. Another interesting strategy I think you guys will you will like quite a lot. How do we define trend? let's define a trend. Again, in this particular case, we're going to do a quantitative definition, and we're going to say that when price trades between Bollinger Band, 1 standard deviation and 2 standard deviation on a 5-minute chart. Now, we're going to use Bollinger Band 20-period SMA, but we're going to use two bands as our chart. I'll show you exactly how that looks on the chart. Let me just sort of show you how it looks on the chart, and then I'll come back to the rules. So, because a lot of people may not be familiar with this particular structure of putting double Bollinger Bands on the chart. This is a 5-minute chart. Here's a 20-period SMA, which is the median line of the Bollinger Bands. This is Bollinger Bands one standard deviation, and this is the classic Bollinger Bands with 2 standard deviations, right? So we define trend quantitatively in this particular setup as price being inside 1 and 2, right? Or if you want to define it even further, as price being above. If the price closes above 1 standard deviation, it by definition is going to be between 1 and 2, right? And sometimes it will even go above 2. But the point is, as long as it's above 1 standard deviation, right, that is trend. And this is a trend channel. You can see using Bollinger Bands, this is Kathy's favorite single way to look at price, is because this helps you identify if price is in an uptrend or a downtrend by looking at the Bollinger Band channels. You see what I'm saying to you? Is this clear to everybody at how we define trend, right? Let me see if there's any questions here. Okay. So let's now take a look at the actual logic of the setup. What we're saying here is on a 5-minute chart, we're going to use 2 standard deviations, 1 standard deviation Bollinger Bands. And this is a long setup. If the price trades in the upper Bollinger Band channel, and sometimes we actually even wanted to walk, what we call walking the line, where and I'll show you what that means, where it goes so extreme it walks on the outside of the 2 standard deviation line. Then we're actually looking for the price to fall out of that channel, fall out of that band, right? And here we're going to just assume that if it falls out of that band, we're going to buy at market. And we're going to put a stop of -10, target of +10. Here's what I like to do. I put a trail stop at +6 as my structure. But I actually, since I've created this presentation, I've changed the structure a little bit. I created what I call a single trail stop adjustment. So the way I trade this is, if price goes +6 in my direction, I move my stop to +3, right? So at very minimum, I'm guaranteed to make 3. And if the price continues, then I'm going to make my full 10. So my choices are the following: +10, +3, -10. Those are my choices for the way I trade this now. It's up to you. I invite you guys. Yes, Kathy uses this on a daily time frame, Ari is saying to me. I invite you guys to choose your own money management structures, but I find this money management structure to be the most robust for me. So -10 on the stop, +10 on the target. If it goes +6 in the money, +3 on the trail, okay? And the short setup is simply the exact opposite. We're looking here for the price to be on the lower Bollinger Band between 1 and 2 channel. And if it pops up above the lower Bollinger Band channel, then we're going to sell with the same structure. So let's take a look at a couple examples. Here's pound dollar, 5-minute chart. Again, all of the other parameters apply. It has to be during trend time. Trend time in this case, 6 o'clock in the morning New York time, right? Prices is a nice uptrend. Pound is going from 35.20 to about 35.60 over a period of about 30-40 minutes. And it comes back down outside of the Bollinger Bands right here, right over here. Just simply, it ends up right below here. And we're able to buy it at around, just at this retrace level right over here. Very, very little retrace to the downside, and it comes back up for like sort of one final push higher. We make our 10 points, right? Here's euro dollar, sort of very, very similar signature price-wise. Prices, this is an interesting point that I want to show you. What does it mean to be walking the band? You see this candle over here? This is the 2 standard deviation band. It's so strong, the breakout is so strong, the price is actually outside of the 2 standard deviation move. It's really expanding the range. The range is really having a big expansion. When you have that kind of an impulse, this is really a price impulse. What is this telling you? It's telling you the market is impulsively bullish. And you can see, by the way, of course, why is the market impulsively bullish? It's taken out the 120 level, right? It took out a very, very key level, 120 level. Boom. We went up through it. So huge up impulse. But we don't chase that up impulse, right? For us to have bought 120 would have been idiotic, because the moment it went 120, it came right back down. It would have stopped us out. We're patient enough, this is the key thing, patient enough to let it come back down to around 119.80. Once we buy that, we buy this level, it's very easy sneezy. It takes about, maybe 10, 15 minutes, and we make our 10 points, because that second wave back up to 120 happens. All we're doing here is being disciplined about our entry by using quantitative measures. This is the key thing, quantitative values to come in, right? This is nothing more than buying trend on a retrace. Every one of these strategies is nothing more than just buying trend on a retrace. The ideas are very simple. The logic, the complexity, the nuance comes in using quantitative indicators, time filters, and proper structures to make sure that we get that 60-40% edge, right? I do not wait for confirmation. This is one where you snooze, you lose here, because the problem is once it comes into the Bollinger Band, right, very often it can just bounce right back up. So I do not wait for confirmation, especially because, remember, Chen, on the RSI structure, we were using 1-minute charts. 1-minute charts are very granular. They give us time for confirmation, right? In other words, if it goes up, on a 1-minute basis, it's not like it's going to run away. But here, on a 5-minute basis, it has a very strong danger of just popping right back up like a rubber band. And I basically missed the opportunity to buy at retrace. So here I have to make the guess. And the assumption here is that my guess, because of all the things I've done beforehand, the proper time, the proper structure, the proper price, is a 60% guess. That's really what I'm looking for, okay? So Bollinger Band, long example. Guys, it looks like I'm definitely gonna be running overtime. Please hang with me. My favorite setup is coming up. So hang out in the room with me. We're gonna keep this going for another 10, 15 more minutes, okay? I wanna spend the time to make sure that you guys all get my favorite setup. Okay, so this seems to be the wrong example. Sorry, this is a wrong. So I'm sorry, this wrong chart. So here's a Bollinger Band, fade long. So I bought it long. I made the money on the euro dollar, right? Here's one on the short side, right? Here's one on the short side. Prices in a lower Bollinger Band trend channel. It's in a down channel, right? Price pops up right over here, right over here. Now I'm short at the close of this candle, so it goes against me. I have to absorb, 9 points, probably 6, 7, 9 points worth of negative price action against me. But it does turn and comes right back down, and I'm able to actualize the trade, right? Here's the same kind of a thing on Swiss franc. We're in a negative trend channel, right? We're in New York Open. It comes back up. I short it, and it comes right back down. No, in this particular case, it does not. I'm sorry. It doesn't quite come back down enough. Does not come back down enough, right? And I get stopped out. Now, you could make the argument saying, well, Boris, if you used your +6, +3 strategy, you probably would have been able to get out of this trade alive. And it's true, I probably would have. But I want to show you sort of the unvarnished view that you're going to get stopped out in these trades. These are not 100% trades in any way, shape, or form. And you need to accept the fact that you're going to get stopped out, because if you have a day where you have 4 stops, you're doing it on 10 trades, you're actually having a great day, right? So here's another one where you do a long fail. This one, the Canadian dollar is sort of notorious for doing this kind of stuff. Here's a big burst of movement. Now, one of the things that I want to caution you on is look at the time and look what's going on here. Why did I show you this example? Well, this was a unique example. This was news. We had this big burst of news that the Bank of Canada was, I forgot what they were, oh no, excuse me, this was NAFTA. that North American trade agreement was going to be revoked. So that's going to be very, very negative for the Canadian dollar. So on a 5-minute chart, it had a massive, massive price expansion, right? If you had bought the trade right over here, it had just a tiny move back up and then it flushed right back down. And why was this a bad trade? It was a bad trade because the news did not have continuation. Now, should I have taken this trade? And my answer is yes, because generally, this would have been a continuation trade. You would have made money. The reason why this kind of flopped over is because there was a second piece of news that said, no, NAFTA is still back on. So there was a countervailing pieces of news which reversed price action. You could not have predicted the second piece of news. So therefore, I think it was a legitimate stop. You could have taken it, right? But one way or the other, you trade the thing and hope that you're 6 out of 10 right. That's really all you want, because you're trading. The cool thing about this is the most important thing, is that when you're losing a controlled 10 pips, nothing more. You do not, under any way, shape, or form, continue to add to the position that is losing for you, okay? So now we get to my favorite trend trade for the day. This is what I do on a day-to-day basis. And I'll caution you guys, this is no more accurate than any of the other ones. In other words, I'm still basically 60% accurate in this particular setup, but that is good enough to give me a positive day almost every single day that I trade this thing. I call this the trend pierce. And here we're going to define trend just a little bit differently. So first of all, we're going to use a 15-minute chart, a little bit longer chart. And the longer the chart, generally, the deeper, the better, the stronger the signal, right? So when the price moves from the 20-period SMA to the Bollinger Band 1 standard deviation on a 15-minute chart. In other words, it goes from that 20-period SMA and closes above the 1 standard deviation or below the 1 standard deviation. That is trend. That is an uptrend or a downtrend. That's how we define trend in our trade. Here's the long setup. We got a 15-minute chart. We put the Bollinger Band 1 standard deviation. Price goes from 20 to 1 Bollinger Band. We buy at market. Same structure. 10, minus 10 stop, target plus 10. I put trail stop here, but I use what I call a single trail, which is if it goes plus 6, I go plus 3. That's it. I just lock it down. And the same thing to the short side. Price now falls from 20 towards the 1 standard deviation on the bottom, on the lower Bollinger Band. And if it pierces it and closes it, the key thing is got to close below that standard deviation. Then I am willing to go long. This is a very good setup because it's mature enough to give you confidence that the breakout usually is real, but it's not so stale that that it forces you to kind of chase price too much. Now, in this particular case, this is Australian dollar. You can see you have a big expansion, move from 78.30 to 60, right, on a 15-minute candle. And then it comes back down. The other interesting thing about the 15-minute candle is that you will get a natural retrace on the 15-minute candle, and you get to buy pretty much after the initial enthusiastic shock wave has washed through the currency. So you buy over here only after the candle closes. This is really critical. And by the way, notice my time frame. This is trading the opening of Tokyo, right? This is 2100 hours, New York. Good liquidity hours for the Australian dollar. This is not good liquidity hours for the euro dollar or for the pound dollar, for anything else. For the Australian dollar, because this is a currency during where there is event risk and a lot of people are watching it, this is a good trend trade structure. So it breaks out. I buy literally on the close of the 15-minute chart, and it's easy sneezy. I make 10 points without even breaking a sweat, right? Here's euro dollar during the New York Open when it's very liquid and has a big breakout here, big move from 1930 to all the way to like 1980. Again, I buy it. It goes against me a little bit, maybe 3 or 4 points, and then within two 15-minute candles, I make 10 points on the move, right? Here's a breakdown in the Japanese yen. Again, this is Tokyo Open. I really like trading the Tokyo Open, which is very good hours for you. I think it's like 8 o'clock in the morning, 9 o'clock in the morning for you guys. If you get big burst moves like here, this is a 50-minute chart, yen gets sold hard right over here, closes like 112.30 or something. It takes about another hour, and it drifts all the way down to 11200 actually, all the way down. You know, big down move, right? So one of my favorite ways of trading this. Here's euro dollar. Again, New York session, right? So, now, euro dollar has been already in a very, very strong downtrend, right? But notice what our rules are. If it goes from the 20 back down through the SD, we get a second wave momentum. And I'm more than happy to take that second wave momentum, short the hell out of it once it crosses the 1 standard deviation. And within about an hour, I get an extension of that down move as we go, right? Now, sometimes you run into a buzzsaw. Sometimes you literally sell the bottom and you buy the top, which is perfectly okay because you don't always get the move. Here's the pound, which, by the way, is notorious for doing this to you. The pound is notorious for like getting you to buy the top or sell the pound on this particular structure, but that's okay. If you traded the pound, for example, in this, in this fashion, where it took out the 1 standard deviation in the London morning, you certainly made money here. So you would have had plus 10 here, but you would have had minus 10 here because you sold this. It didn't go down far enough, and then it came right back up and reversed against you. And here is a failure of the Canadian dollar. Notice, by the way, the theme here. What are the currency pairs that fail the most? The pound and the Canadian dollar. Those are just notorious for not continuing. We're looking for pairs to continue. One of the reasons is they actually do continue, but because they are so spiky and so volatile, they stop you out, right? And this is the other existential question you want to ask yourself that I have resolved myself, but one that I think you should ask yourself as you're trading this. Given the fact that there's a currency pair that has a much higher probability of coming back down 10, only then to resume and give you your profit, what do? Do you expand your stop? Do you change your parameters so the risk reward is no longer 1-to-1, or do you stick with a 1-to-1 risk reward ratio and make less accuracy? And I've chosen the second because ultimately, what I want to do is focus on accuracy. I do not want to change my risk reward parameters. I want to stay in that 60-40 proposition. In this particular, where's the 20 SMA? It's this red line, this little red line. This is the 20 SMA. The middle line, the middle river that runs through all of the Bollinger Bands is always the 20 SMA because that's how Bollinger Bands are set up. So that's the trend pierce. That's kind of my favorite setup. Now, I was going to take you to the charts, but we're kind of running out of time. So I think, if you guys indulge me, I just want to take you to these charts, and let me just show you the setup and just show you how it could have been traded. So I'm on a 15-minute chart here. What is this? Oh, this is Bitcoin. Oh my God! Everybody having fun with Bitcoin? Okay, we're definitely not going to trade Bitcoin right now. So here's an interesting, structure. Here's euro, right? And this will be interesting for you guys to track. Euro actually, right now, as we speak, has sent a buy signal for me. This is a 15-minute chart. It closes around 22.44, right? So I went long 22.44. It came all the way down to 36, so it came very close to stopping me out. So I'm in at 44. Stop is 34. Targeting 54. Is it going to work? Maybe, but it's a legitimate setup. I'm willing to take it, at this point. Here's dollar yen. Dollar yen actually sent me a signal just to, while we're doing the webinar here. It broke the Bollinger Band at 73. So I'm short 73, targeting 63, right? But remember, in my case, is if it goes 6 in the money, which in this case it's already went 6 in the money because 73 to 67, it's definitely 6 in the money. I'm now holding my stop at 70, so I've guaranteed to lock down at least 3 points in this particular structure. But if this thing comes down to 63, over the next couple of minutes, I will have made full 10 points on this particular structure. So you can see how to trade, how to trade works, right? How to trade just simply pops up in New York, in Asia, and in London trade. Let me see if there's anything else here. If there's any other pairs. Well, Australia certainly sent a very, very strong signal here. This is very easy. It's almost unfair to show it to you, but it shows you a classic trend pierce that I love. So 3 o'clock in the morning to me, which is I guess the afternoon to you, maybe 7 o'clock in the evening to you. This is London Open, good liquidity time, good trend time for me to trade. Aussie breaks out, closes at 79.66. I buy 79.66, right? My stop is 56. My target is 76, and it just comes up, and it makes my target. It takes about an hour to make my target, but it does make my target in a very, very smooth fashion. So you guys can see, how that's working. So throughout the day, I usually find 2 to 3 trades per session. So that's about 10 trades a day. And when the dust, settles, hopefully 6 of those are positive. 4 of those are negative. If I have a super good day, sometimes I can have 7, maybe even 8 trades that are positive as I pick and choose the best spots I can. That's my go-to bread and butter trading strategy. It's very risk control. That's my favorite one. I invite you guys to, of course, test out and try all of them. I know there's some people in this room who love to trade my RSI and do really, really well with that. A lot of it is really dependent on your psychology and your attitude. But all of them, I think, are very legitimate and very worthwhile strategies for you guys to consider on a day trading basis. So Albert I think I've answered your question, that I stick to the pierce. That's my favorite strategy. Albert is asking me, if I trade 10 trades a day, how do you divide those 10 trades a day? Yeah, basically, sort of 3 pairs, 3 sessions. Obviously not 3 sessions. I do need to sleep, so I will usually I pretty much try to trade. I'll trade the Asia Open, I'll trade the London Open, and then I try to really get serious in the New York London. Basically, I try to get serious between 7 to 10 o'clock in the morning New York. The 3 hours, 7 to 10 o'clock in the morning New York, is when I try to get serious on all my trend trades. That's when I try to focus and try to pick out as many opportunities as possible. Piso, I'm sorry, I'm butchering your name, but it's super hard for me to pronounce. He's asking, Boris, would you advise for or against targeting 50, 60 plus pips a day trader when my average stop loss is 25 pips? I advise against, because if you can make 50 pips a day, my friend, I'll give you all my money. If you can show me you can make 50 pips a day, every single day, I'll give you all my money. I think it's really hard. I think I target 20 pips to 25 pips a day, and on an average day, which means that some days I'm going to lose 50 pips, some days I'm going to make 50 pips. But on my averages, if I can make 20 pips a day on an average basis, I'm a happy puppy. It's just my personal experience. Your experience is going to matter differently. Are you able to show Bollinger Band setup on MT4? Yes, I am. Okay, so Forrest, thank you for asking me this. Bear with me. I actually have the Pepperstone set up. If you guys, I just, we're running over time, but you guys seem to be really into it. So let me just show this to you. It's super easy to set this up. Just give me a second. I'm just logging into my VPN. So as you can see, this is 2 Bollinger Bands. One Bollinger Band is 1 standard deviation. One Bollinger Band is 2 standard deviations. And the middle line is right over here. So the purple is 1 SD, the green is 2 SD, and you can see how we are within the uptrend here on the 15-minute chart for the Aussie. So this is how it works on the MT4, right? Here we are on pound. I have to go to the 15-minute chart. Oh, Euro doesn't have it, so I actually have a template here, so I can go to BB Look, and here's the BB Look. Euro actually just dropped out, right? Euro totally faked this out. So this is this is a great example. So I'm going to get, remember I said to you, yeah, we just got stopped out. So You know, one trade was legitimate, one trade was not, and that's how that's how the whole thing rolls. You know. You're never gonna, you're never gonna. So in this particular case, we kind of came down to 65. So we would have locked down at least 3 points on this particular trade, right? On the yen, you have to not care about any given trade. You have to look at this as a basket of trades, and you have to try to pick, the best opportunities you have. Now, euro, of course, obviously also had, by the way, just sort of, is this last night? This is last night, right? This was last night when we traded this. I had a very, very strong feeling that we're going to run 23s, and you can see this power move in the Asia session. This is a 15-minute candle here, right? If you bought this candle over here, the close was 22.92, and over here, the low was 85 or 86. So I would have survived my 10-point stop, and it was an easy 10-point move over here. And it totally, created an easy trade here. Same thing over here. We broke out to the 1 standard deviation over here, and this is when Constancio, I think, said that that he wants to do more quantitative easing. If you took the short over here, you'd have been plus 10 over here, right? Another easy sneezy peasy short, right? So you have plus 10 here, plus 10 here, minus 10 here. That's how it goes. As a matter of fact, if I have plus 10, minus 10 for the rest of my life, I am like Puggy Pearson. I'm making money anytime I trade. How do you put the second deviation on? You simply put Bollinger Band twice. Let me show you how to do this. I'll show you how to do this on the MT4. You guys want to see this? So you guys all know. Let's erase this, right? And we have a 15-minute chart. You can obviously any time chart you want. All we got to go is go into insert. We go into indicators. We go into trend. We go into Bollinger Band, right? And in this case, we're going to go standard deviation at 2. First, I'm going to lay down the 2, right? So here's 2. Now I go right back in indicators, trend, Bollinger Band, right? In this case, I'm going to change it to 1. And if I want to change my color so I can differentiate the color, let's make it red. Let's make it, I don't know, make it orange, okay? And now we have orange. So this is, orange is 1 and purple is 2. And now you have 2 bands on the thing, okay? Leah is asking me, hello, can you give again the parameter for indicators you used on the purple? And the green one, I was not able to take it down. It's just exactly as I showed you. 1 standard deviation, 2 standard deviations on the Bollinger Bands. Just to lay down the Bollinger bands, to lay down both of them. My method of trading, is it called scalping? It can be. It's not really. I prefer to call it day trading. Scalping is a more technical term used primarily for market makers, where you buy the bid, selling the ask, and it's even shorter term time frame. We cannot, as retail traders, ever do this, and that's why I don't encourage you. Generally, when I say I use short term trades, I mean 1 hour. Okay, I don't mean 1 minute. I don't mean 1 second. I don't mean instant. You have to have at least an hour to 2 hours per trade. That's short term. That you may say, wow, you spend an hour trying to make 10 pips. Yes, that's what it takes. If you want to make 10 pips, you got to give it an hour to make the trade viable. So I think that's it, guys. I think we've exhausted everything. Thank you so much. I hope you guys enjoyed. As I said, the Pierce is my friend, and I'm going to trade the Pierce. Let's just see what's setting up on the. In order to do this, I'm actually going to delete the. Wait, cancel. What's this? Oh, delete indicator. Yeah. So right now I just left the one SD because I like to look. Obviously, I like to look at one SD as a clean slate here. The euro has nothing. Yen, obviously, we traded it to the downside. Pound looks like it's well. Let me get rid of this. Sorry. Pound broke out a while back. It broke out at around 89, and it's basically already made our money, right? At the beginning of the session, if we bought 89s, we would have had a chance to make our money. Aussie already made our money on the upside. Maybe, let's see. Actually, you know what? Let's just change this. Hang on. Let's see how pound yen is doing. You pound yen, you could make a legitimate claim. I mean, it's kind of already broke. It broke out here. What was the close here? 75. How high did it go? No, it didn't quite make it. So you could make a legitimate claim that if this closes above this in the next 15 minutes, this could be a buy. This could be a buy for a 10-point move. The point being is, you want to trade at the right time, and obviously not in front of news. We don't have any news now at 6 o'clock in the morning, so everything is kind of passed by. And we're looking. It looks like maybe dollar yen could make a run towards the 111s today. We'll see. And if it does, that's certainly going to be a very easy 10-point move here. So for now, there are no signals. They may reappear starting the New York Open, and there'll be opportunities there. The point being is there's always opportunity. There's always an intelligent way of trading, and I hope that I've showed you today that you can do this logically with control and hopefully be on the 60-40 end of the proposition. I do not trade support resistance. No. I trade round numbers. I like to trade those things, but I don't trade the bigger picture, because on a day trading basis, I'm looking for short-term momentum moves. That's what I'm looking for. I try to not. The whole idea here is don't clutter yourself. Unclutter your mind. Unclutter your charts. Unclutter your money management strategy. Keep it as simple and clean as possible, and then you'll be in control of your trading. All right, guys, I have gone way over time as always. Thank you so much for hanging out. I'll be glad to send the PDF over to my guys at Pepperstone, and please ask them. Maybe they'll post it as well. So the rules and everything else will be in the PDF. Okay, thank you so much, Anthony. We're good to go. I'm out. If you guys want to visit me, come to bkforex.com or come into our Slack room. I'm happy to trade with you guys. Everybody have a wonderful, wonderful time. I will see everybody in a couple of months. Take care.
All right. Thanks, Boris. Bye.
Bye.